Hello, good afternoon. How's everybody?
Doing good. How are you?
Good, thank you.
Good. How are you, Chris? How are you, Oscar? Well, I see, I'm glad to see three of you. You're like early birds, but I didn't see anybody in the discussion board a while ago. Let me yeah, let me share my screen and let me show you. So I hope you have read the the emails that I sent out in the last couple of days, and I see, okay, Chris is there, right? So I believe these are basically there are 5 people in the Collaborate currently. 5 people. Good. So, good. Everyone is everyone is caught up, right? I mean, um, so let me just reiterate. This is something that has already been communicated through my emails already. The first thing, let me switch to. So far, you've received only 4 emails. Was it 5? 1, 2, 3, 4, 5. This one, I don't know if this was sent out, but the as I probably mentioned this in the the tour, right? The video tour of the structure, the configuration of the Blackboard course, right? I probably mentioned in that video, but everyone, please take this down. Please, take a note of this, because BMCC email, you know, any email coming from you automatically goes into the junk mail folder. So, and I got I got tons of email every day that comes to junk mail folder. So I can your mails can be most likely go undiscovered, and if it's undiscovered, then it gets periodically deleted automatically, um, deleted periodically. And I want to I do my best, I do my diligence to salvage anything. I rummage through my junk mail folder diligently every day to salvage any email from the students, but then I do not succeed all the time, because there's there are literally tons of emails in the junk mail. So most likely your emails will go undiscovered. So please don't send email to my BMCC account. Just send it to my personal email. Now, so the class size hasn't increased. I have, on my last check, there were 22. Let me check that again. So I believe it's still 22. Oh, what's going on? Schedule. Okay, since I'm sharing my screen with you, you must be able to see this too. So fnb300f210826. So this hasn't changed since like a week ago, I believe. So that's not you. That's not, this is your class. So you must have all received this. So I'm not going to go over this again. But as a standard protocol, right? As soon as you join the Blackboard, you got to go to the discussion board and report attendance there. That's what okay, that's what you saw a while ago. So and then attendance is 10% of your grade, and therefore will only the attendance reported within the first 30 minutes is recognized, is validated as present. And if your one presence, each presence is worth 0.33 points, and the threads created afterwards will be validated as late. So that's going to be a 1/3 of presence, 1/3 of present, and your total attendance will add up to 5 points. So because this is the reason why it is 0.33, 5 divided by 15 weeks, right? And we meet once a week, and each one semester must consist of 15 weeks. That's and 3-hour course must meet at least 45 hours, right? 45 hours a week, a semester, I'm sorry. So that's, because it's 3 credits, 3 hours per week times 15, right? That's going to be, 45 hours. Now, so, but why only 5 points? Now, on the other hand, I mean, I used to give 10 points for attendance, but then, there was no room to accommodate participation points. So to accommodate participation points, to create room for participation points, I I cut it in half. So 5 points for perfect attendance and 5 points for participation. But participation points are not limited only to 5. I mean, it's theoretically just to make 10 points, but you can have more than 10 points from class participation. So the wording is a little off here because during the collaborate sessions, I will, every once in a while, I'm going to ask you, I'm going to prod you with questions. And if you give me a great answer, that will be worth 1 point. You will earn 1 point. If you give me a good answer, you will earn 0.5. If you just give me an average answer, 0.25. So if you give me 5 great answers, that's already 5 points. So together with the attendance, that's going to be 10 points. But you don't have to give me only 5 great answers. You can give me 10 great answers or 20 great answers. Suppose you gave me 20 great answers. What's the total attendance and participation points? 25. That's raw 25 points. And you may have also you may have taken a look at the syllabus, and I must have my syllabus there, but let me open that. So if you go to course information, and I hope you have all checked this out. And in the course there's the syllabus, and I have opened it. So here's the breakdown of we're going to have 4 exams. Actually, final, there will be a final, not project, but, sometimes I have the option of, either choosing, final or final project. But the online pandemic situation, online class situation doesn't lend itself, very well to class the project. But anyway, it's gonna your semester grade will come 20% from midterm 1, 20 from midterm 2, 25 from midterm 3, and 25 from the final. But then they all add up to only 90%. So where does that the other 10% comes from the attendance and participation? But it's so I told you it's gonna be raw points. I mean, everything gets weighted. In other words, everything gets scaled down by this percentage. Everything gets weighted, but attendance won't get weighted. It's raw number. So in the past, it used to be just if you had perfect attendance, 10, just that 10. So if you got 100 in everything, the weighted average will all add up to, weighted average will come out as 100. But now, one downside was that during in an online class, it's hard to tell. Whether someone just logged in and signed into the discussion board and signed in, and they can just they can still stay logged in to collaborate, but they can just walk out, do something else. I mean, they may be totally disengaged from the class while still logged in online. So I started to apply this participation points. So if you are actively engaged in the collaborate session, then you will get a chance to answer my questions. And if you give me great answers, this is basically a chance to earn extra points. So as I said, if you give me like 20 great answers, then that's 20 points plus 5. If you have perfect attendance, 5 points, so 25. So that easily, for example, you messed up in one of these exams, you messed up, that easily more than compensates for one of them. So think about it. 25 points is like, if you got 0, in midterm 3, that will compensate for midterm 3. At least, that of course, you will 15 out of that 25 points will will compensate the 0 in whatever, midterm 2 or midterm 3, and still 10 points will still remain there for your attendance, supporting your attendance. So that's the reason. Okay, that's the reason I. Is someone trying to say something? Because if your microphone is on, and unless you're trying to say something, there will be a lot of background noise. Sometimes it is my own voice being echoed back. So if you're not trying to say something, please keep the microphone muted. All right, so that's the idea, right? And so this class is like a 2-lane highway. Okay, this class is basically conducted like a 2-lane highway. So there are multiple lane highways, 4 lane, just one direction, another 4 lane, 4 lane the other direction. But the idea is very simple. The fast lane for fast moving traffic, the slow lane for slow moving traffic. Now, not everyone is the same. Some people are fast movers. They don't need, I mean, my lecture is delivered by the pre-recorded videos. So that is the main lecture. Don't think, you must not think that the Collaborate session is the main lecture. No, Collaborate is not the main lecture. Collaborate is actually a supplemental lecture, supplemental. I intended the Collaborate to be like an aftermath, where you review and reflect on the main main lecture. So the main lecture is for today. You got to go into the course materials, and if you're there, what you can see, you see only the first topic folder. You click on that, and you can see only today's lecture videos and the supplemental materials. But first of all, these are literally says, please download the above files and use them with the video. Okay, this is imperative because you would need to have these files open in front of you, especially the Excel file. This one is the file that I'm using in the lecture video. So whatever is being demonstrated, right? And also this is the reading material, and also I'm using it in the lecture. So you have to have those two files open, and when I'm demonstrating the Excel models, you must do it also simultaneously. You will need to replicate and simultaneously emulate, right, the model, the process, right, the modeling process. And if you have taken Finance 100 or Finance 230 with me, you know already, how it works. So you need to have those files downloaded and ready and open and ready. While you are watching the video, of course, you might need to pause because you cannot actually to follow the Excel steps. You cannot do it, simultaneously with the at the rate of the video, at the rate the video is going. So you will need to pause the video. Okay, so please feel free to pause the video and just backtrack everything. Backtrack. So where was this? What happened here? And you do that until you are have completely replicated the process and ended up in the same end result as my demonstration. Then that confirms that you did it right. And it would take probably some people are very quick learners and they comprehend everything very quickly, and just doing it once will be enough for them. But for most people, you might want to try it out as many times as it takes for you to fully digest it, right? It's important to digest the material. So, and that's the reason for making this video, leaving these videos, for 1 week. So so it's like a reading assignment. So in the uh, pre-pandemic days, when we had in-person classes, there were reading assignments. You do that assignment, you read the materials before you come to class. And then in the class, we can uh, reflect on that, review, and reflect and discuss. Um, so the reading assignment is, imperative to participate in class. But so it's just not reading. It's an like reading assignment, but just not reading. It's watching, video watching assignment. Okay, so you have to, of course, what is assigned today. We will be because today we have 3 hours. I'm normally in 1 hour, 2 hour classes. The videos assigned. It's just assigned today, so students will have to watch it, and then in the next class, following class, which will be like 2 days later or 5 days later, then we can reflect on that. But we will do the review also today, because we meet only once a week, and there are only 15 sessions, and excluding Thanksgiving, we don't have that week, so that's official. I mean, official holidays. So, there are other official holidays too, like Columbus Day, but Thanksgiving is part of those 15 weeks. So if you take out Thanksgiving, then we have only 14 weeks, 14 sessions. So with only 14 sessions, there's no room for reviewing and reflecting in the following week. So we're gonna do it simultaneously, but this is basically uh, uh, all these videos are like 30 minutes in length, so that's 5 videos, and if I remember correctly, a lot of it, up to like video 8, I believe, is like 7, video 6 and 7 are pretty much the review of um, bond valuation that you learned in Finance 100. So we're going to be, it's not that difficult to review this today. And we're going to also talk about, so So we're gonna basically review everything today. Well, of course, I cannot play the video because it takes time. I'm gonna just, conduct the class and collaborate and uh, review as we go along. Now, so, and also other supplemental materials, please, download. I mean, we may not directly use it during the class, but these supplemental materials will be useful to catch up with the main lecture. Now, so back to back to the two-lane traffic. So some people who are fast movers don't might probably want to use the class time. It's 3 hours, so it's plenty of time. They can use that time to watch the assigned videos. But for people that need more, that are slow movers, and for people who don't, who need to pull up the car and uh, uh, take their time. You may have to check the road map, or you may want to eat something. You may want to stretch your legs. Um, might need to drink something, coffee or look. So if you're in the slow lane, you can pull over to the side of the road, called road shoulders, or you can easily, pull into the rest area. So collaborate session is like that. It's like road shoulder or the rest area where you can take your time. So, but also even if you are, so you can ask questions, um, you can ask questions in the collaborate session. I mean, you would have difficulty, fully, comprehending the material, and you ask questions in the collaborate session. But even if you are a fast mover, still there is benefit in diligently participating in collaborate session. Why? Because as I said, I will be prodding you with questions, every once in a while, and if you give me great answers, then that's the opportunity to rack up, extra points, right? So let me give you let me give you an example how it works. So this is just FNB 100, and I believe you can see this because I'm sharing my screen. And this summer, right? Summer session, right? FNB 100. And in this summer session, it's all anonymized, no names, just this is the grade distribution. And look, so in summer session I use like 20%, the weighted average. I mean, for FNB 100 I use the same rule, 20% quiz 1, 20% quiz 2, 25% midterm, and 25% final, 10% attendance and participation. So this is how it is calculated. No way. And this person didn't do very well in quiz 1. I mean, it's not that bad, but it was just about average. For the average was what? Quiz 1 average was 75, 79. So did better than the average, but in terms of standard deviation was very wide. So, but not very far away from the mean. But generally did well. And then look at this person's attendance point. You can tell by far this person did very well in participating in class. In other words, this person gave me at least, think about it. If this person made perfect attendance, 5 points from perfect attendance, but 12.5 came from some combination of great answers, good answers, and average answers. And so if we go to, so this is the summer session was 5 weeks, 4 days, 5 weeks. So summer session 2, summer 2. So each day, if you're present, is 0.25. And then it was, and who had, this person has 17.5. So that is the result of, first of all, each day, right? This person got, it's clear, this person gave me a great answer on this day, because 0.25 is, just for attendance. 1, that means 0.75. He or she earned, 0.75. That means, either 1 good answer and 1 average answer, or that's the only way, or 3 average answers, right? But anyway, look how that person benefited from diligently taking part in the participation. So that's why you need to participate in the collaborate session, right? Even if you're a fast mover. All righty. So I have already explained, this is something you already saw in the tour video, right? In the course tour video, right? So that was, and these are the, this was also emailed out to you. The holidays in the fall, September 4th through 8th, nothing applies to you other than Thanksgiving, I believe, because that doesn't, 4 through 8, it doesn't fall on Thursday. 15 through 16, oh, 16, 16, that applies to you. So we won't have class on the 16th, and then we go to after September 9th, then we meet on the 23rd. And then
okay. Never mind.
What? Were you saying something to me? Did someone?
Yeah, this is Ebony. I'm sorry. I thought I read something wrong. You can continue.
Oh, okay. Yeah, no problem. Yeah. Yeah, these are basically, Jewish holidays, Rosh Hashanah and, Yom Kippur. And I'm very thankful to, Judaism, because they gave us these many holidays. So I'm very thankful. And then, October 11th, that would be, Columbus Day, Also, that also, oh, no, that is November. I'm sorry. October 11th. Yeah, I was wondering why, that's Thursday. How can it be a Columbus Day? But, so we have, and November 25th is Thursday. So we have 2 official holidays. So please, take note of that. Okay, and by email, I already explained why I want no emails to be sent my BMCC email. Now, let me quickly check discussion board to see how many people are there. Yeah, 17. That means 16 actually, because I'm also included in the number. And it says after signing in, you got to go to my posting and check out what's for today. So it's bond valuation part 6 through part 10. So that was the that was what was in the there in the course materials folder, right? So I want to get started with today's lecture. I mean, once again, this is not the main lecture. The main lecture is basically these pre-recorded videos. That's the main lecture. I'm gonna review. I'm gonna start reviewing because it also covers the it's reviewing because it also covers Finance 100 material, because what you learned, we are refreshing on what you learned in Finance 100 about bond valuation. So I want you to download these files now. Please download those files, and I will give you I will put the class on like 10-minute break, and so in the meantime, please download those files, and we'll get started on the review in exactly 6:36. So let's say 6:45 Welcome back. Anna, you raised your hand, so you have a question?
Yeah,
Anna?
I do. Hi, Professor. I do have a question.
Yeah.
I have a what was that?
I didn't say
Are
anything. You,
we
you were,
using a
you,
book?
hmm? Yeah,
Are we
yeah, yeah,
using?
the textbook. Look, we're not gonna read the book, right? It's for reading the book is, something you do in your own time, okay? But you need the book because uh, you need to have access to Connect, right? McGraw-Hill's, online platform. You need to have access to Connect because all the exams, all the practice problems will be on Connect. Okay. Um, so if you click on if you have downloaded uh, the syllabus, and I did, 300 syllabus here. No, I didn't. I did. And in the syllabus, you can click on the book link, right? And then it will take you to the McGraw-Hill's microsite where you can directly purchase, or you can order from the bookstore, right? BMCC bookstore, right?
Okay,
And
because
I
I tried the link and it
no, no, no.
didn't.
Okay, so I think the link, I I fixed the link. The link was, somehow it's always the old link. When I revise this, it's still somehow the old link. So uh, I directly revised it from in the PDF file. So so it's been fixed. So if you click on it, it's going to take you here. Okay, and pay attention to the address, web address. The web address is exactly the ISBN number, isn't it right? That's the ISBN number. That's the ISBN you see, right? That's the ISBN number you see here. Okay. So if you previously downloaded the file and if you clicked on that link, then you would have noticed that the web address and the ISBN number showing on the web page doesn't match the ISBN on the syllabus. It was because the old edition link was, stubbornly, sticking, uh, there. So I fixed it. All righty. So,
I got it. Thank you.
all right, you're welcome. Anyone else with any more questions? Okay, if you don't have, uh, we'll take a 10-minute break. It's already 6:39, so 6:40. So we'll come back at 6:50. Okay, I'll put you on pause. Okay, all right. All right, we're back. We're back. So, okay, I gotta share my I gotta share the screen. All right, so I hope you guys have you have those files open in front of you. You should have two files. You know, one the PDF file, right, and the other one the Excel file. Okay. Now the Excel file, when you open it, it may not look exactly like this because you may have. I already expanded the rows, but previously the rows were some rows were hidden. You understand? If you look at the row numbers, you will see there's a gap. Some row numbers jump, right? So um, So I collapsed some rows to temporarily hide some examples, but I want you to expand all the rows. In other words, unhide. So what you need to do is just click on this corner. I call that northwest corner, and once you click on it, the entire spreadsheet will be highlighted. And then you go to home, and then go to format. Okay, everyone is following. And then go to, you will see visibility, hide and unhide, and the menu in the menu box, select unhide rows. Okay. Then once you do that, and everything will expand. The rows will expand, and you will have all the problems. Okay. Now, so everyone has done that. Everyone is okay with that. Any questions? Any questions so far?
On my
right.
side, on my Excel, it doesn't give me the option of the arrow.
It doesn't give you the option of arrow. What arrow are you talking about? You mean the cursor?
Yeah.
No, cursor will always show. As you move your mouse, don't you see the cursor?
No.
What arrow are you talking? I don't see any arrow. But
No, I'm talking about, yeah, like right there.
when you click that,
Yeah, I
and
don't
then
have
in
that.
the up there, you see. Can you see home? Do you see home?
Yeah, I
I
have the
can't.
home option.
Okay. And then click that, and then the it will expand. Right? It's called ribbon. I don't know why they call it ribbon, but it will expand. And when it expands, then you see this segment. This segment. That's and then you see format. Oh, you mean this arrow? You don't see this arrow?
No, I got it. It was the other arrow, but I got it now. Thank you.
Okay, you got it. Okay, good. So then go to hide and unhide and unhide rows. Okay. Alrighty. I heard a ding, so that means somebody was typing something into. Okay. Yeah. You need to also enable editing, right? Because when you download it, did it? Because it is my file and made by, but you can, I didn't lock it. I didn't lock the file. You can edit it. You must enable editing. Okay. Okay. So I would assume that you have no problem retrieving this file and expanding all the rows and rows, I don't want the columns to be expanded, but just the rows. And so before we move on, let me write something on the whiteboard. So everyone remembers basic, bond valuation formula, right? Bond, this is, when we say valuation, that means, it's also sometimes called pricing, but valuation is different from actually price. Value is different from price. Okay, why? Think about it. Value means what it is really worth, right? Intrinsic value, right? But the price is something that can deviate from value, from intrinsic value, right? Because of demand and supply, right? Now, for example, $100, okay, let me, diamond, what kind of intrinsic value does a diamond have? 1 carat of diamond, maybe, I don't know how much, but, could be hundreds of thousands of dollars. 1 carat, maybe tens of thousands of dollars. Okay, but why is it worth? I mean, is it really worth? Why is it like that? Is that the intrinsic value of the diamond? And if you think about it, intrinsic value is the rational, true value of something. I mean, a diamond cannot, it doesn't even have intrinsic value of an apple, because an apple, I mean, at least, it may be 10 cents. An apple may be 10 cents, but at least, it can, you can eat it. It can quench your thirst. It can, if you eat enough of apples, enough number of apples, it can fill your stomach, right? But diamond, what kind of utility can you derive from it? What kind of utility? Can you eat it? Can you? The only intrinsic value would be derived from industrial use, because diamond is the hardest material in the world. It can cut anything. So cutting any hard materials, you have to use diamond, right? But that would be the industrial value. But other than that, diamond rings, why is it like, K Jewelers, or all these De Beers diamond commercial, you have seen it, diamonds are forever. Yeah, because it's the hardest material, it goes forever. But then, why is it like, a diamond ring? Why is it like, tens of thousands of dollars? It's only because of demand and supply. Demand and supply. And another thing is, when you buy a diamond ring, it is, let's say it is, $10,000. When you sell it, it's $1,000, right? So it's not a store of value. It doesn't even store value, right? So now you understand the difference between the value and price, right? So when we say valuation, that means to find what is the intrinsic value of the bond or of the stock, right? Because the price in the market price, you can check the market price. You can go to Yahoo Finance and check the stock price of, Amazon. Amazon is about 3,000 something. And I'm saying Amazon may be worth, but intrinsic value of Amazon may not be exactly 3,000 something. It could be, 2,000 something. Or Tesla. Tesla is, I haven't checked Tesla for quite a while, but I can quickly check it. Probably it's about $700, around 700. What was that? But there was a big question. Is Tesla really worth, about 2 years ago, I think early like 2020, early 2020, it was probably like $1,400 or something. And if you bought Tesla when it was 200, you really made, big return. But after that, there was a big sell-off. Price dropped, to my keyboard is not responding. Yeah, I guessed right. It's about 7. It's only today, but looking at the and there was also a split at some point, so you cannot say this is the last 5 years. Last 5 years. Try last 5 years. And monthly, let's see, monthly price trend. Because of the split, they had a split here, which was, and after split, the closing price was, now that was crazy, right? Don't you see? It opened at 289 and closed at 498. That was and the split was 5-1. That was August 8th, 2020. So that means if at close it was 498, was this day. That means everything, the price prior to that split was 5 times higher, but after split, then they prorated or recalibrated the X split price. I mean, a pre-split price to be aligned with X split price. So if it was like $500 after split, right? Then that was like $2,500 pre-split. But this is I have to check because Tesla never went up to 2,500. It was probably around 1,600. So I'll have to check that. That was 2,000, and there was no other split. But when Tesla was like currently it is 719, and this is this was that made about 4 something. So now, so big question is was Tesla really worth 1,600 before the sell-off? I mean, the sell-off happened around I don't remember when that really happened, but and right after the sell-off, right, the price went down to 800. But if Tesla is really worth, if its intrinsic value was like 1,600, right, even after the sell-off, the price would not drop like it shouldn't drop like that. Like it shouldn't lose like 50%. And then after that, it went down to like 400. And then from there, it started to climb again. So think about it, from 1,600 to 400, that's like, losing, 3/4, 75% of its value. And that's just because of, after sell-off, the price will drop a little. But if it is really the correct intrinsic value of Tesla, then it shouldn't drop like that. 75% drop. No, that means all that 75% was all, bubble. Okay, all that between, 400, above 400 was all bubble, right? 1,200 was bubble. So price is just pumped up, price can be pumped up if there's, very strong demand, regardless of the intrinsic value. So that's why we want to find the intrinsic value, because we want to know if the price in the market is currently overpriced or overvalued or undervalued. Consumer sentiment plays a role in stock. Yes, of course. Consumer sentiment means, it fuels the demand. Fuels the demand. And it's mainly the people who want to jump on the bandwagon. If Tesla, so among those people who were buying Tesla in early 2020, a lot of them didn't care what the intrinsic value of Tesla was, right? They don't care what the intrinsic value was. They just want to, because the price is being pumped up and more people are buying, strong demand will just, pump up the price, and they want to buy when it was already, 800. It wasn't too late, right? But nobody knows how much it will go up, how far. But those who bought it, years ago when it was $200, then they certainly made big, big windfall gain. But even when it was 800, it wasn't too late, because Tesla eventually went up to like 1,600, and at that point, they started to sell a big sell-off. But nobody knows when. They know it is overvalued, but they don't care because they want to sell. I mean, think about it. If you buy at 800 and when it is 1,000, you sell. Still, you make, what's that? You bought it at 800. You made $200 profit, which is, in return, 25% return already, right? 25% return. So, but you can still keep buying Tesla until it popped. But nobody knows when it's going to pop. Nobody knows. But it is already close. If you know what is the intrinsic value, it is overvalued. It's all inflated, right? So at least if the intrinsic value was 400, you knew already, after 400, it's all bubble. It's gonna pop at some point. But at least it's gonna pop. At least you can tell whether it's overvalued or undervalued. Okay. Someone dropped a chat because I heard ding. So that's why we need to know. I mean, Tesla was an extreme example. But usually, when it is, overvalued by like 10%, you should already start to be ready to sell, right? And we know overvalued asset is not a buy target, it's a sell target. And undervalued asset is a buy target, right? That's why you need to know what is the intrinsic value. So so we know this is my notation for intrinsic value of the bond. Okay, this is the intrinsic value of the bond, not the market price. Market price of the bond, I use the different notation. But we need to use, so if you remember the bond valuation formula, it's the coupon. There are many different variations, but they all come from the same formula, and you can simply tweak it. But I don't like any other variation. I like this formula, this form, because it's not too complicated, not too many layers. Oh God, it's difficult. R times 1 plus R raised to N plus face value of the bond. And what is the face value of the bond? Anybody? Again, you can, if you give me a great answer, you get 1 point.
Is it 1,000?
Yes, it's always $1,000. You know, face value of the bond is always all, you know, uniform, $1,000. Okay, and who was that?
Sabrina.
Sabrina. Sabrina. Okay, I'll give you 0.25 because this is something that this is a straightforward. So Sabrina, you got 0.25 for that answer. And today is August 26th. This is fnb300. All right. So I can show you different other variations of this formula, but it's not necessary at this point. And this is the best formula because it's the simplest form. Now, yeah, I said, you know, all bond face value of the bond is 1,000. It's uniform, you know. It's except the municipal bonds. What is the face value of the municipal bond? Anyone? This is, you know, FNB 100 material. Does anyone remember what is the? So only exception is the municipal bond, right? What's the face value of a municipal bond? Anyone? No one? Oh, don't type in there. If you're typing in there, I can't see. I'll have to get out of this. And someone type in
100?
100? No. How can it be 100? 100. Look, 100 is just the way they quote. You remember in 100, you learned that the although the face value of the bond is 1,000, we express when they quote the bond price, they express it by percentage. Okay, percentage of the face value. So 100 means it's not $100, it's 100%. 100%. Okay, everyone is clear about that. So 100% of 1,000. Okay. And if it says, you know, 95.3, what does that mean? It's not $95.30. It's 95.3% of 1,000. You understand? So that would be $953, and that would be like, you know, the market price of the bond. That's how it is quoted. Okay. So the municipal bonds, face value of municipal bonds are $5,000. 5,000. How come nobody remembers this? This is, you know, Finance 100 material. So other than so only municipal bonds have $5,000 face value, and all the other bonds have, you know, $1,000 face value. Okay, and the reason, and I told you before in Finance 100, if the price, you might think, oh, Amazon was, you saw that the Amazon was like 3,000 something today, but then Tesla was 7 something, but Tesla had a split. It was like, you know, it was very high, and I don't remember at what point it split, because after the split, then all the prices are, you know, prorated to all the prices prior to the split is prorated to align with the X split price. So I don't remember, but you know, another good example is Apple. Okay, I like Apple. I just don't like iPhone. I like Apple as a company to invest in. I like Apple. Now, Apple. You think Apple is past 5 years? Maybe I'll have to use more longer timeline. 5 is maximum timeline. And the maximum timeline will give you a very interesting picture. So I will use, you know, annual price. Please don't type. If you can speak, you know, please speak, because if you type into that chat box, I can't see. You know, what you see is what I see. You know, I'm looking at Yahoo Finance, so I'm not. You know, I cannot see what's going on in the chat box. Okay, I'll have to move away from that. Of course, Apple is a tech company, right? Apple is a tech company. I mean, we all know that, right? We all know. So you might think, you know, Apple currently it's 147 year, and how much was it? Like, you know, 2013 was it? In 2013 it was only like December 2013. It was here, and that was like close prices 29. Was it 29 in 2013, December 2013? No. I already told you, Apple had several splits. Apple had several splits, and in 2000, so this doesn't give you a full picture. In 2016, they had most recent split was in 2016. So it looks like, you know, this is the entire life of Apple, right? In 80, they went public in 81. In 81, so what was the price in 81? It looks like it is, you know, 10 cents, 14 point. Look, no. The IPO price was about $10. $10. But why is it like that? I've been telling you, after split, they prorate the pre-split price to align it with the post-split price. Because if you don't do that, then there will be a big shift in the price. It's like, you know, before split and after split, it looks like, you know, the stock dropped drastically, right? In other words, you know, the data won't have the data trend won't have any continuity, right? So I told you in 2000, around 2014, Apple was it 16? About $660. I know, because I'm an Apple shareholder. I mean, I used to I sold Apple and then bought back again, you know, years later. I had only 10 shares of Apple, right? I bought I bought them in 2012, and then, and I believe in 2014, it went up to like 660. And when I bought it, like it was 600. I paid 600, and then it went up to 660, and then they had a split. I shouldn't have sold it, but I wanted to. Although I had 10% return, but I just wanted to realize that return, because until you sell, it's only paper gain. It's only paper gain. So you have to sell to realize your return. So I just, just, it was just a 10 shares. I just bought them as it was experimental 10 shares. I wanted to realize that 10% gain. But after I sold them, it went up to like, it went up more. I don't remember, about $800 or somewhere. And then I can, and then they had 7-to-1 split. That means one stock, one share, split into 7 shares. So if I had 10 shares, right? If I had 10 shares, then after split I will have 70 shares. Of course, my total equity value will still be the same. It's the same thing, just split into smaller. So why? Past 5 years, let's take a look. Monthly, annual, past 5 years. So the most recent split was, this was when? This doesn't give me, okay, I will have to assign the date range, time range. So it should give me a better way of doing this. I should be able to move years more. Let's go all the way back to maybe I bought Apple shares in 2014. Okay, and then you see, there was a split, and I know there was another split. Most recent split was here in 2020. It was 5-to-1 split, 5-to-1, and then this split was in 2014. I know, yeah, June of 2014. So so at the time, it was 7-to-1 split, and the price was, like almost $800. And then after the split, the price, so 800 divided by, just, simply 800 divided by 7, right? 800 divided by 7. So then it was not 800, because after split it was like $89. So it was probably 700 something, or close to 690 or something like that. The point is, why did Apple split? I mean, throughout the life of Apple, it had several splits, maybe not 10. If they didn't split in 2014, the price now may be, the price now may be about, $3,000 or whatsoever, right? Because when it split, I remember it was almost $700, and at the time the adjusted post-split price was was like $25, almost 25. But then think about it. Compare that with, take the ratio, right, between 25 and like 680, and just simply so I can I'll quickly do that with the calculator here. Where's the calculator? Okay, did it open? Okay, so now 680 just divided by 25, just roughly. So 27 times, 28 times, even 28 times. So then, if currently Apple is what, 170. Currently Apple is 147. So 147 times, roughly, let's say 27 times or 25 times. Yeah. Almost, it should be $4,000. It would be more than, it would be the market price would be more than Amazon, right? You understand? So then the question is, why did Apple split? Why did they keep the price low? Why did no? There is a good reason. Now, think about it. High price isn't necessarily a good thing. Why? High price makes it more burdensome, more onerous for the traders, for the investors, right? What that means is, if I had $4,000, if I have $4,000 today, and if I want to buy an Apple stock, how many shares can I buy? Huh? I mean, by today's price, I can buy 4,000 divided by 147. And that's what that's the number of shares I can buy. But if the price didn't split, if Apple didn't split, but kept on going, the price would be almost $4,000. So if I have $4,000, I can buy only one share of Apple, right? But what's the problem here? What's the issue? Now think about it. If I need urgently, if I need $1,000, if I need to cash out $1,000 urgently, if the price is for 147, if the price is 147, and if I have $4,000, how many shares could I buy? 4,000, like 20. I believe it is like 27 shares. Divided by 147. Yeah, 27 shares, because that's what I assuming that I was still holding and the price didn't change. With $4,000, I could buy 27 shares, and all I need to do is simply, if the price is 147, I can sell only about 6-7 shares and cash out 1,000 and keep the rest of them in stocks. And still, as Apple grows, I will benefit from Apple's growth. You understand? But if Apple was still like $4,000, 3,009 something, then I can only buy one share, and with one share only, I cannot. Can I cash out 1,000? If I urgently need 1,000, can I cash out 1,000? No, I cannot conveniently cash out 1,000, because I cannot conveniently sell a fraction of the stock. Right? Do you understand? So that what does that mean? I will have to sell I will have to sell that one share, then cash out $4,000 just because of 1,000 I need. Okay, so this makes it what? This makes it less marketable. I mean, if the price is too high, it makes the stock or any asset, bond or any stock, especially stock, because bond has already preset the face value. This makes the stock or any financial asset less marketable. Okay, if it is less marketable, then it becomes less liquid. Becomes less liquid. Of course, it's not necessarily less liquid. I mean, I can sell Amazon if I have Amazon, 10 shares of Amazon. I can sell one share, but that's still $4,000. I mean, if just to meet the need for 1,000, I have to sell one share, and 3,000 that could have remained in the stock and still could have earned, benefited from the growth of the stock. That is forfeited. That's foregone. That's foregone, right? So that is another. That's the downside. I mean, the marketability goes down. I mean, in terms of liquidity, stocks still have good liquidity, but then it makes me hesitate. It makes me hesitate to put my 4,000 in the stock. Do you understand? So the same reason. That's the same reason. I was talking about the municipal bond. Remember, you shouldn't lose the train of thought. Actually, it's my train of thought, but the reason and then think about it. If the municipal bonds are $5,000, the face value of it is $5,000, doesn't that mean wouldn't that be less marketable than face value of 1,000? Yes, it's clearly less marketable than corporate bonds or treasury. That's 1,000. But municipal bonds are not frequently traded. I mean, most of the majority of the municipal bonds are held by large institutional investors, such as insurance companies. And insurance companies and large institutional investors don't need immediate liquidity. I mean, they have liquidity, of course. They don't need that money right now, right? So it doesn't have to be the marketable, because they will put a huge amount of money into municipal bonds, and then they keep it there for 30 years, and then 30 years later, during the and in the meantime, they collect hefty coupon interest. Municipal bonds coupon interest is somewhere between corporate bond and the treasury bond. So obviously, it's less risky than municipal bonds, but riskier than less risky than corporate bonds, but riskier than treasury. But municipal bonds are relatively very safe. Of course, in case of New York City, a big city like New York City, but some municipal bonds, some municipalities go bankrupt, right? So it depends on the credit rating of the municipality. Even California government went bankrupt a couple of years ago, right? I don't remember exactly when. That was early, early 2000s, and Arnold Schwarzenegger was the governor of California at the time. You can look up when he was the governor of California, and that was the time, towards the end of his term, California state government went bankrupt. So the bondholders and all the municipalities, state governments, city governments, they have bonds outstanding, and they had to sell a lot of excess state government properties to raise money to pay the bondholders. Even California, state of California went bankrupt, and city of Bridgeport, where it is, Connecticut, Bridgeport, Connecticut. They went bankrupt in early 1990s, I believe, early 1990s. So the city, there was a lot of outstanding municipal bonds, and the city was in trouble for quite a while. But anyway, that digressed. I digressed a little because I had to explain, why municipal bonds have, face value of 5,000. But anyway, back to our question. So this is the face value, not the face value. This is the intrinsic value of the bond. Face value is always 1,000, and this is the simplest form of the formula. They have different variations. All those variations are all crazy. That's something that, and it also nicely separates, right? Nicely separates the present value of the coupon, which is the present value of annuities, right? This is the present value of all annuities because coupons are annuities. And then this is just the present value of the par value. I said don't please just say it because I cannot see. I'll have to switch the screen. Okay, if you drop something in the chat box, I have to switch the screen to see it. Okay, so if you have something to say it while I'm on a different screen, right? So if you are asking a question there, it won't be answered because I cannot see it. Also another thing is another benefit is this formula shows basically because it's separate. Look, when you must understand that somebody got disconnected, I believe. When the discount rate goes up, right? When the discount rate goes up, what happens to the price of the intrinsic value of the bond? When the discount rate goes up, what happens here? Anybody?
It loses value.
Yes. And who is this?
Damien, I just got onto the Collaborate, sir.
Okay, all right, Damien. So Damien,
Arthur.
Okay, I'll give you 0.5.
No, I signed in already. I was watching the videos, but then I just came over to the Collaborate, and I went to the one on top. I just tried this one, and it went through.
Yeah. That's fine. That's fine. So you're watching today's video, right?
Yeah, I was watching the videos.
Okay, good. Yeah. And can anyone explain why the value of the bond goes down when discount rate goes up? So this is logical reasoning. So this part, if you answer this, then you'll get 1 point. But can anyone answer that? I'll give 5 seconds. 1, 2, 3, 4.
Is it because when you divide the coupon rate by a larger number, it's gonna give you like a smaller and like
Yes, that's the it's not coupon rate. This is the coupon, actual coupon payment, actual interest, right? This is it's not coupon rate. is coupon, right? It's dollars, right? Yeah. Think about it. Coupon payment is a constant. It's a constant number, right? It's a constant. And if when the discount rate goes up, think about it. Everything, the whole fraction will have to go down. This fraction will go down. This fraction will go down because you're dividing a constant by a larger number, right? And this will also go down because as this goes up, you're dividing it by a larger number, and face value is also a constant, right? So all the numerators are constant. You divide it by a larger denominator, the whole fraction goes down, right? But then let's think about the effect. So if effect of n, if n goes up, okay, if n goes up, what's going to happen to the bond value if n goes up? Anyone? Okay, before I go on, who gave me that answer a while ago? Who gave me that answer?
That's me, Anna.
Anna?
Yes.
Okay, okay, Anna. All right, Anna, I'll give you 0.5 because you basically got it right, got the logic, but you call this coupon rate, okay? So it's not rate, it's actual, coupon payment. So it was a good answer. You got 0.5. Okay. Do we have 2 Annas in this class, just to make sure, so that I won't? I believe only 1 Anna, hopefully. Yeah, Anna Karen, right?
Yeah, that's me.
Oh, okay, only 1 Anna, so there will be no confusion. Okay. All righty. So,
So for the second question that you made, like, wouldn't it be the same effect because you're still like the denominator still getting is like still higher?
yes, but the conclusion is no. Is it still Anna?
Yes.
Okay. Yeah, but look, when n goes up, the denominator grows, denominator gets bigger, so this term will go down, right? And this term will also go down as n goes up. But what about this? This is not affected at all, isn't that right? This is not affected at all. And besides, the greater the n, and think about it, this number is being subtracted from this number, right? And you might wonder, oh, what if this number is greater than this number? No. If this number is greater than this number, it can never happen. Why? Because then the bond value is negative. It doesn't happen. And think about it. Because you're dividing a constant by either the discount rate, and the discount rate raised to n, so no matter what happens, I mean, this, as long as r goes up or n goes up, the number that is being subtracted from this number gets smaller and smaller and smaller. And as this number gets smaller and smaller and smaller, the difference will get bigger and bigger and bigger. And then no matter how small this gets, but this still gets added to this number. So the whole, the final result, oh, my mouse got stuck. The final result is the bond value going up. Okay, so then this is an interesting thing, but intuitively, it may logically you might stumble there a little. But the thing is, think about it. What does this mean? The longer the period, longer the maturity, the greater the future. Think about it. The longer the maturity, you are collecting more coupon interest. You are collecting more. So all that, numerous coupon interest must increase the present value of the bond, right? Makes sense? That's intuitive understanding already. That's an intuitive understanding. Okay, so but then think about it. If you express this formula this way, this version of the formula is already that explains that distinction. I mean, why when n goes up, the bond value goes up as well, whereas when R goes down, the discount rate goes down, the bond value, when discount rate goes up, why there is an inverse relationship. The bond value goes down. There's an inverse relationship, right, between the discount rate and the bond value, but there is a direct proportionate or commensurate relationship between the n and the bond value, and that this version of the formula shows that very clearly. That's why I prefer this version of the formula. Although there are other variations, they are all just too clunky. They are too clunky. So with that in mind, right? With that in mind, let's do a couple of these first, and let's do this one first, right? The one, this one, right? So here, this is the face value. We know that. This is the coupon rate. This is the compounding frequency per year, and in case of bond, it's always semi-annual, so twice a year, right? And then, this coupon payment is already given. No, I want you to delete. If you have this file open, I want you to delete all the highlighted cells. Delete all the highlighted cells, okay? Because all the highlighted cells are at least intermediate calculations or solutions. So did you delete all the highlighted cells? I should have said this before. Did you all did that? Everyone? I don't hear anybody. How come? Did you delete all of them? I would have to assume that you did. And if you did, now let's take a look at this example. So face value, it's always 1,000, right? Coupon rate 5.5. Time to maturity 15 years. So this was probably a 20-year bond or 30-year bond. Now at this point it has 15 years left, and the this is actually yield to maturity, APR. I use the APR, the symbol APR there, but that's the discount rate. But it's annual rate. So the actual discount rate, which is the periodic rate, because every 6 months the bond is on semi-annual cycle. So every 6 months, the actual rate that applies is this divided by 2. Okay, so the periodic rate is the discount rate that we use. Okay, and then what is the coupon payment? Coupon is basically 1,000 times coupon rate, but you gotta divide it by N, because 5.5% is $55. 5.5% of 1,000 is $55, right? But then bond is semi-annual, so every 6 months you get half of that, right? So we simply do that. The coupon is then $27.50, okay? And 15 years, with 15 years left, how many actual coupons, how many do we get? In other words, how many semesters are there? Of course, 30 semesters, we know that. But you don't manually input, you don't manually type in 30 there. You only type in the initial input data, then otherwise the rest of them, you must find it by soft coding. You must find it by formula, right? So by soft coding. So there you go. So we got payment, everything, we got coupon payment, we got par value or maturity value or face value, we got N, we got R, so we can use that formula, right, to solve for the bond price, present value of the bond. So which is payment over R minus payment over open parenthesis R times other parenthesis of 1 plus R raised to N close parenthesis plus face value divided by plus R raised to N. Okay, I got it already. When I close the so now, if you think about it, this, yeah, exactly. I built that formula in there, and some people may wonder, okay, if I compare it. Yeah, coupon divided by R and coupon divided by R times 1 plus R raised to N. Now you might think, oh, then do we have to put parentheses here? I mean, there's R times 1 plus R, there's parentheses this. But yes, you have to put parentheses here. Why? Because if you don't put parentheses, then what's going to happen? D8 divided by H8 will happen first, right? That's going to be executed first, and then the result will be multiplied by this. So then it's simply a PEMDAS rule, So did everyone get the same result? Let me know. Tell me, did everyone get the same result? How come nobody says anything? Are you there?
Yeah, Professor, I just was paying attention because I'm unable to open up the other screen.
Okay. Anthony, you got the same result? Anthony, I saw your microphone going.
Yeah.
Lighting up. Okay, good. Sabrina, did you get the same result? Sabrina?
Yeah.
Okay, great. How about you, Anna? Did you get the same result? Anna?
I'm still working on the Excel, trying to get the same one.
Okay. All right, take your time. Take your time. But don't take too much time because, from the next class, we won't have this luxury of too much time. I wanted to do other examples as well because there are more examples to come. And they are all like a review of, Finance 100. You might also have noticed that The first three, these three problems had $1,000 as the face value, but this one has 100, 100. Why? Well, those problems are basically using, they are expressed in the percentage, okay? Um, I told you bond prices are quoted as percentage of the face value, right? So this 100 doesn't mean, $100. It means $1,000, 100% of 1,000. And then this should also be in, a percentage, but, then it should be 4. But, I'm going to come back. But here, everything is expressed as a percentage, right? So look at this example. Once $1.75, is that the coupon payment, coupon interest? No, it's $17.50 because it's expressed as percentage. But why did I do this? Because here in these examples, I want to use Excel's built-in function for price and yield to maturity. But to use that, you have to express all the prices as percentage of the face value. So that's why a little difference there. Since today is the first day, the class runs until 8:45, right? 8:45. Okay, so we still have at least, let's take a 10-minute break. We still have, I will let you go by 8:30, but it's 7:56, so we'll reconvene at 8:05, okay? 8:05. Bathroom break, okay? Basically, you need to use the bathroom.
Professor,
Yeah. Go ahead.
this example that you was just showing us, you just added that. You added that top part.
No. It was already there. You need to unhide all the rows. You need to unhide all the rows.
Unhide all the rows.
I explained. You were not.
No, I told you I was trying to get into the
Yeah.
collaborate on the other one, and
Yeah. So I explained that before you joined the collaborate.
okay,
You need to.
so
So you see some. You see some rows are. If you okay. If you look at the row numbers, you see some row numbers are hidden. Some rows are making jumping from like row 8 to row 15, or you see it's unnatural, right? It's because I deliberately hid some rows. Okay, so just to focus on just a couple of examples. Um, so what you need to do is click this corner, right? If you click on this corner, the entire spreadsheet will be highlighted, and then you go to Home and go to Format and go to Visibility, Hide and Unhide, and go to Unhide Rows. Okay, you select Unhide Rows, and all the rows will expand. Okay, the collapsed rows will expand. Okay. Did you hear me? Damien, did you hear me?
yes, sir. In the left-hand corner, you said.
Yeah, upper northwest corner,
Okay.
the upper left corner, right? All right, we are back. We're practically back, and already since like 2 minutes ago. So let's continue with the other examples. So let's do the ones that are about the. So you see the highlights have rules. The highlights are not random. You may have noticed that the yellow highlight is the primary solution cell. Yellow highlight is the primary solution, and these olive green or drab um, is like intermediate calculations. Obviously, bright yellow catches the eye, so that's the primary solution cell. Otherwise, just unhighlighted cells are just initial input data. So we did, already. So then, if you think about it, um, the examples that are about the bond values, there are only two of them, and then the rest of them are about the this one is about the yield to maturity, right? These two, and another one is about uh, time. So this one, it's already filled. Well, I told you to delete everything in the highlight, right? So let's delete that. So here, so first of all, yield to maturity is the ultimate, primary solution here. But to get to yield to maturity, you need to find internal rate of return. That means you need to find R, which is the periodic rate, which is the 6-month rate. So how do you find it? Again, but this one alone, we have to use Excel's built-in function. Why? Because in annuity, right? This includes annuity. Bond includes annuity, and solving for rate in annuity, there is no one unique solution. There's no one single unique process, not solution. There's no one single unique process to find it. So normally they in the days before the computer, they had to use trial and error method. First, use the guesswork, and through reiterative process, which is basically trial and error. You try this number, and if it doesn't work, then you try a number smaller than that, and if it gives you way off result, then you try a higher number. Or doing this multiple times, and by narrowing down the range, you may eventually get to the exact rate. But then getting to exact rate, there's no guarantee that it can be done within the couple of tries. It may take infinite tries. It may take infinite reiterative loop, right? Because to nail down the exact value, in the days before the computer, you couldn't do that. So you just have to settle for an approximation, right? But now we can find it. We can nail the exact value. So basically, what you need to do is go to Excel's function here. You can click on this, right? And then normally you will see the most recently used functions listed here in the menu box. But if it is not listed, you go to the financial category, because we are doing the financial calculation. And it's in alphabetical order, so you scroll down until you find rate, because rate is what you want to find. All right. Hit enter, and then n period, that means n periods. So what does that mean? It's obvious, n, right? N periods, you enter it. And then payment, yeah, you enter payment. No, I'm sorry, that was n. And for payment, you enter payment. Okay, stay in this row because we're doing this problem, row 3. Present value, yeah, this is the present value. But remember, you got to enter the present value as negative. To use financial calculator, you have to, one variable must be, one input must be a negative. Okay, why? I'm going to get to that later. Future value, yeah, there's the future value. There you go. Type, leave it blank. Type means, annuity type, whether annuity due or ordinary annuity. If it is ordinary annuity, you enter 0 or just leave it as blank. Leave it blank. If it is annuity due, then you enter 1. And if you took Finance 100 with me, you understand why you enter 1. It's because, every annuity due has one more compounding than ordinary annuity. Okay, that's where that 1 comes from, because of one more compounding. But bond is annuity, ordinary annuity, because you get the coupon at the end of every 6 months, so you leave it blank, and then you get something already here, so you have to hit OK. Then yeah, that's the 6-month rate. Okay, but then annual Annual is simply the 6-month rate times 2, right? So yield to maturity is 6.2. Okay. So this is not this is actually not the unlike, think about it, unlike this problem. In this problem, in this example, this is our unknown. This is our unknown. So that was our intrinsic value of the bond. But in this example, this is the market price of the bond. Okay, so that's not the intrinsic value, and hopefully the market price would be equal to the intrinsic value, but in the short run, it's generally not. They are the market price is kind of misaligned from the intrinsic value in the short run. The only, but it can be equal to the intrinsic value. If it is equal to the intrinsic value, then the asset is correctly priced, right? And then this asset is in equilibrium price. This asset is in demand and supply for this asset has exactly met each other. So this asset is in equilibrium, and that doesn't last very long. Equilibrium is an ephemeral thing, or it's a fleeting thing. Fleeting, right? Equilibrium is a fleeting thing. It doesn't. It happens once in a while, but it doesn't remain there for. So this is the market price. Market price is something already known, because you look up Yahoo Finance. Actually, bond prices are not listed in the Yahoo Finance. You have to go to RFI. I forgot the acronym, but it's a government agency that has this it's what used to be called it's not government. Okay, it's not government agency. What it used to be called, NASDAQ, not NASDAQ, but the National Association of Security Dealers site. And it is now called, they changed the name, RF something. I'm gonna have to look it up again. And there you can check the bond quotes. But anyway, so the price of the bond is not the unknown, but the discount rate is the unknown. So we first found the 6-month discount rate times 2. That will give you annual discount rate, which is the yield to maturity, right? When we have the everything else is known, but the rate is unknown, solving for the rate, that's the yield to maturity. Okay, so we did that one. How about this one? Oh, how about this one? This one, interestingly, it has time expressed. Oh, before we do that, we can do this, but let's do this first. Time is in calendar date. So time 0, the genesis, the birth of this bond was January of 2000, and then maturity is 2030, January of 2030. So usually, bonds are not necessarily issued on the first day of the month. It can be issued at any point in time, but usually, 15th of the month is used, as the 15th of the month is the usually used as the birth of the bond. So that means, then this will be like January 15th, 2000, and the maturity will be January 14th of 2030. But anyway, finding the this one. So think about it. This should have been deleted, right? It should have been blank, and I like that. So obviously, what you can do is simply first you need to know how many years. We know it is 30 years, but let Excel take care of that. It will give us 30 years. But first, if you do that, no, it's not in years. What is that? That's in days. Okay. Why? Because we use calendar date. Excel basically, when you use calendar date, Excel counts time by days. So what do you need to do? You'll need to divide it by 365 for the years, right? And over 30 years, how many compoundings happen over 30 years? In other words, how many coupons are paid? Anyone? How many coupons are paid over 30 years? Hmm?
The year times 2.
Yes, exactly. Where's this times this? Okay. So, and who was this? This is Damien?
Yes,
Who
sir.
was this?
Damien, yes,
Okay.
sir.
All righty. So for that, you get another 0.25 extra point for that. So we got everything. Now, let's find, so it's the same problem, right? This one and this one, they are the same. So I'm not, from now on, it's the same process. I'm not going to do that again. I just wanted to show you that, this one is expressed in 100. So in this case, no, actually, to solve it as, to solve this again like that, we will have to have this as 1000. I believe the reason I had 100 there is because I wanted to use Excel's yield to maturity formula. But that exercise, that example is here, so we're going to do that later. But then let's do this one as the last example. So here, let's find what is n. And then if we find n, then we can trace it back to when it was when was the birth of this bond. Okay, and if you, I don't know, if you took finance with, finance 100 with, which professor, but I don't know how they do it, but I teach basically with formula. Okay, so the formula for n is, if I remember, I gotta let me open this, because just to did I put it? I wonder if I put it there, but the review you can see here, down here. Review of bond basics. I think that is, review of bond basics. That's fnb300 material, I believe. But anyway, I have already downloaded it, so let me just open that. Let me just open it here, okay? Oh, not this one. Actually, not this one. What am I doing? TVM. Where is? Okay, where is it? Okay, here's the formula for n, right? Here's the formula for n. In in annuities, right? In case of annuities, but we're out of time, running out of time, so I'm not gonna. I'm just showing you. It's in the. I will just use, because I used, rate formula. I will use n formula here. N. So here, the name of the variable we're looking for is n periods. N periods. So you click that, and then give it what it's asking for. So the rate, I should have also filled in that, but we know the rate. Rate is, this is the rate. Actually, I should have had it, in this row. What can we do? Payment, there. Present value, okay. And don't forget, you gotta make that negative. And I forgot to explain why. Well, in financial calculator, it's not really a negative number. It just means it's cash outflow. Because this cash outflow, it's leaving your pocket, leaving your wallet. So it's negative, right? Cash outflow. And all cash inflows are positive. So payment and future value, the face value, are all positive, right? All positive. That's it. And type, you don't need to, something's not right. It cannot be 100. Why is it 100? H3 rate is not H3. Why did it, what happened there? Yeah. All right, H3 is correct. D4 payment, D4, I4 and negative, future value, face value A. And type, again, you don't have to put anything because it is, something's not right. Something's not coming out right. You hit enter? No, this cannot be. Why? So something's not right. Discount rate, first rate. There you go. It should come out as 60. Payment, yeah. And present value, negative. Why is it not? It's not working. So something's missing here. Something's not right. A4. Okay, I'll look into this. Something's not right. But you will, because it's the same example, it will have to come exactly. I'll have to come exactly as this one, right? So
Professor,
yeah.
I was also having trouble with the Excel sheet because the numbers that you have on yours didn't match the ones I had on the one I downloaded, so I had to adjust them, and then Like for example, the IRR for that example, I got 3 and not 3.10.
No. It's the same thing. Look, look. It's only a matter of, look. I think what it is doing is, it's just Excel is by default set to round it to an integer. So it just looks like this, but it knows. It just on the surface it is 3, but you gotta always use at least 2 to 3 decimal places. So
Yeah, I
there,
did that. I included the 2 decimal places, and it just says
increase it.
3.00.
What? No.
Yeah, I'm not sure.
You
I think
you
it's I changed the
probably
numbers.
no. Do you see the formula there? Do you see the formula? I mean, do you see the
Yeah.
Excel's function there? So if it is Excel's function, then it should give you this. It cannot come out as integer 3. Okay, it should come out as, if you give it 2 decimal places, it should come out as 3.10. Okay, so I'm gonna let's see. But basically, the basic input data, they are all the same, right? Face value, 1,000, 8% coupon rate, they are all the same thing, right? Isn't that right?
Yes.
Okay, so okay, then there is there is nothing wrong. I don't know why it misbehaved, why it acted up this time, but it should give you exactly 64. All righty, so we're out of time. We'll continue on next Friday, next Thursday. So please finish up all the assigned videos for today. And
I need a few minutes, Professor, when you finish.
no, I don't have. I'm afraid I don't have a few minutes. So
Because I still wasn't able to get those to unhide because it's not showing like that on my computer. So I wasn't able to get the first 5 examples.
Did you do this? And
I tried. I don't have that little box. I don't have that little triangle on the download. When I'm looking at it, I'm not seeing that little triangle nowhere. I'm just seeing it as FX. That's it, and then it goes straight to 6.
no. It's just this corner, the northwest corner. It just
Right. I'm not seeing it like that, sir. I've been trying to see it. I'm not seeing it like that at all. So I just been following along.
Okay. All right. I will have to address that through my office hour. So I have to go. So
fine.
send me an email to schedule an appointment for office hour. Okay, because I
Yes,
cannot
sir.
see your screen. I cannot, and I don't think you can share the screen. So
That's fine.
I
I'll
cannot
wait.
see what's going on. Yeah. So we'll talk about that another time in especially in office hour, maybe next Thursday. Okay. All
No
righty.
problem, sir.
So all right, you're welcome. I'll have to stop recording and stop sharing first, and the class is
Professor, really
dismissed.
quick before you go, there's no homework for this week, right? It's just watch
No,
those time
not
lectures and do.
yet.
Okay.
Not
Thank
yet.
you.
All righty. It will be assigned. It will be emailed to you. It will be posted in the announcement, and it will be emailed to you when there is one. Okay. So I'm gonna just look for the email. Wait for the email. Okay. All right. Have a good night and stay safe. And I will see you guys next Thursday. Okay. Have a good one.
All right, sir. Thank you. Good night.
All righty. All right. You're welcome. Class dismissed.
Thank you. Take care.
You too.